So, someone hands you a mint tomorrow. Not a candy, not a herb. A facility. A building the size of a city block, somewhere in the industrial district of a capital city, where enormous presses stamp blank metal discs into legal tender at a rate of several hundred coins per minute. The sound is rhythmic and industrial, something between a heartbeat and a hydraulic press, and somewhere in that noise, you are manufacturing the one object every human being on the planet uses every single day. Whether this makes you rich depends on variables so counterintuitive that some of the best capitalized governments on earth have managed their mints into operational losses in the same years their currencies were in highest demand. There are mints producing billions of coins annually that lose money on every single one. There are small numismatic operations stamping a few 100,000 collector coins per year that generate margins that would embarrass a software company. The difference between those two outcomes is not volume. It is economics. And the economics of a mint are almost nothing like what most people imagine when they picture a building that makes money. The first number you need is this. The United States Mint reported net revenue of approximately $2.6 billion in fiscal year 2023. On the surface, that sounds like the business of the century. Then the Mint's own annual report shows that Seigniorage, the profit returned to the Treasury after all production and operating costs, was approximately $318 million. The gap between $2.6 billion in gross coin revenue and $318 million in actual seigniorage is not a rounding error. It is the entire story of how a mint actually works. That $318 million figure is published in federal budget documents every year, and it rewrites everything you think you know about a building that stamps metal into legal currency. The United States Mint employed roughly 1,700 people in 2023 to produce that $318 million of net value. The average partner at a mid-sized accounting firm does comparable annual revenue with 3 associates and a shared conference room. That is not an argument that minting is a poor business. It is a statement about what kind of business it actually is: capital-intensive, volume-dependent, and structurally constrained in ways that no amount of operational efficiency can entirely overcome. Before you see a single coin come off the press, you need to understand what a mint actually is. It is not a printing press in a vault. It is a precision manufacturing facility operating under federal law, environmental regulation, treasury oversight, and labor contracts with specialized union workforces. The equipment inside a modern mint is not stamping crude discs. It is running carbide alloy dies at tolerances measured in micrometers, managing automated inspection systems that reject off-spec coins at high speed, and maintaining metallurgical consistency across billions of blanks sourced from commodity metal markets. Entry into this business at any meaningful scale is not a transaction. It is a generational infrastructure commitment. At the smallest viable end, a private mint authorized to produce commemorative medals, art bars, and privately issued bullion rounds, the capital requirement starts around $3 to $5 million. You need a coining press capable of at least 60 to 120 strokes per minute, which runs between $400,000 and $1.2 million new. A blanking press to cut discs from metal strip, $150,000 to $400,000. An annealing furnace to soften blanks before striking so they accept the die impression cleanly, $80,000 to $250,000. An automated sorting and inspection system, $120,000 to $350,000. A burnishing drum for finishing, $40,000 to $90,000. A set of hardened die pairs for a single coin design costs between $1,500 and $6,000, and dies wear out. A production die typically yields between 100,000 and 300,000 strikes before it must be replaced or relapped. You need edge lettering collars for any design that requires them, and a secure facility with controlled access, 24-hour monitoring, and an insurance policy your broker will spend considerable time explaining to underwriters. At this scale, you are not producing legal tender. You are producing products that resemble coins and compete with coins on collector shelves, but carry no face value and no government guarantee. The revenue model is pure product margin. The risk is entirely yours. One tier up, a mid-scale private mint producing authorized bullion coins under contract with a foreign sovereign government, the capital cost rises to between $15 and $40 million. Here the press room runs multiple high-tonnage coining presses, typically 150 to 300 tons of striking force for larger bullion blanks. The blanks themselves are purchased from commodity metal suppliers and priced daily against the London Bullion Market Association spot. If you are striking silver eagles, silver maples, or any authorized silver bullion coin under license, Your metal input cost moves every 24 hours and your contract price with a sovereign is typically fixed at a per coin manufacturing fee that does not move. When silver rises from $24 per ounce to $30 per ounce, your blanks cost 25% more and your manufacturing fee stays exactly where it was when you signed the contract. You absorb the difference. The die cost per design is now multiplied across dozens of annual releases from a client government that issues new reverse designs each year. A typical authorized bullion program might require 8 to 15 new die sets annually. A full facility at this scale employs 80 to 150 people, carries annual payroll of $6 to $12 million, and operates within environmental permits governing metal dust, chemical rinse water from burnishing operations, and acid used in the etching of proof dies. At the full sovereign mint level, a government-owned facility producing circulating coinage, bullion, and numismatic products under a national mandate, the numbers stop resembling a business and start resembling a public utility with a budget. The Royal Canadian Mint's Winnipeg facility, which produces circulating coinage, operates on capital assets that the Mint's annual report values in the hundreds of millions of Canadian dollars. The United States Mint operates 6 facilities: production plants in Philadelphia and Denver, a bullion depository in Fort Knox, a gold and silver depository in West Point, a coin manufacturing facility in San Francisco, and its headquarters in Washington. The combined replacement value of that infrastructure is not publicly itemized at the asset level, but the Mint's annual capital expenditure runs between $50 and $150 million in a typical year just to maintain existing production capacity. These are not startup costs. They are maintenance costs for infrastructure already built over more than 2 centuries. The mechanism that makes a mint either profitable or insolvent operates on one mathematical relationship: the gap between what a coin costs to manufacture and what that coin is worth the moment it leaves the building. That gap is called seigniorage, and it is the oldest revenue model in the history of organized government, predating central banks, income taxes, and public debt markets by several thousand years. When the Roman Republic began debasing its silver denarius in the 3rd century by reducing silver content while maintaining face value, it was harvesting seigniorage, taking the spread between intrinsic metal value and legal tender value and using it to fund the state. The mechanism has not changed in structure, only in scale and sophistication. A modern 1-cent coin in the United States costs approximately 3.07 cents to produce, according to the Mint's 2023 annual report. The face value is 1 cent. The seigniorage on a penny is negative 2.07 cents. Every single penny the United States Mint produces destroys roughly 2 cents of taxpayer value. In 2023, the Mint produced approximately 4 billion pennies. The arithmetic is not complicated and the result is not ambiguous. Except when it costs more than it's worth, and when it does, the losses are mandatory, because circulating coinage is a legal obligation, not an optional product line. The nickel is worse. At a production cost of approximately 10.9 cents against a face value of 5 cents, every 5-cent coin issued in 2023 generated a seigniorage loss of roughly 5.9 cents. The United States produced approximately 1.4 billion nickels that year. The total seigniorage loss from pennies and nickels alone exceeded $179 million in a single fiscal year. This is not a crisis. It is the structure of the business. The losses on small denomination coins are legally mandated and cross-subsidized by the profits on larger denominations and on numismatic and bullion programs. A dollar coin costs approximately 17.7 cents to produce and carries a face value of $1, which is 82.3 cents of seigniorage per coin. The quarter costs roughly 14.1 cents and returns 10.9 cents per piece. Stack the denominations from penny to dollar and a modern Mint's circulating coin program looks less like a manufacturing business and more like a portfolio of cross-subsidized public utilities, some of which have not been economically rational in decades, all of which must be produced regardless. The seigniorage principle holds for quarters, half dollars, and dollar coins. It inverts badly for pennies and nickels. And the Mint cannot choose which coins to produce based on economics, because the denominations of legal tender are set by statute, not by margin analysis. The second mechanism, and the one that separates high-performing sovereign mints from those that merely break even, is the numismatic and collector product program. This is where the economics of a mint most closely resemble a luxury goods operation rather than a public utility. The Royal Australian Mint, the Perth Mint, the Royal Canadian Mint, and the British Royal Mint have each built substantial commercial operations producing limited edition proof coins, colored coins, coins containing meteorite fragments or gemstones, commemorative sets in custom packaging, and annual subscription programs for dedicated collectors. The gross margin on these products is not comparable to circulating coinage. It is not comparable to most consumer goods. A proof coin containing 1 troy ounce of 99.99% pure gold might carry spot metal content worth approximately $2,000 at current gold prices. The mint sells it for $2,650 in its collector packaging. The manufacturing premium, over and above the metal cost and the production cost, is captured entirely by the issuing authority. The Perth Mint's commercial operations generated revenues of over 20 billion Australian dollars in recent fiscal years, driven largely by its bullion and precious metals refining business, but its numismatic margin on collector products runs substantially above the institutional bullion business. A single themed collector coin series, say, a wildlife series, a lunar calendar series, or an anniversary commemorative, might run 5,000 to 50,000 pieces at margins exceeding 30% above metal and production cost. That is software company margin on a metal disc. The British Royal Mint expanded its collector and gifts business to the point where it now operates a retail experience centre in Wales and an e-commerce platform generating tens of millions of pounds in direct-to-consumer revenue annually. The third mechanism is bullion, the striking of investment-grade coins sold at a small premium to spot metal price to institutional and retail investors. The American Gold Eagle, the Canadian Gold Maple Leaf, the South African Krugerrand. These coins are not collector items. They are investment instruments in coin form, and the premium above spot at which they sell is thin, typically 3 to 8% for gold, somewhat higher for silver. The production economics look entirely different from numismatics. Volume is high, margin per unit is narrow, and the profitability depends almost entirely on the efficiency of the blanking, annealing, striking, and inspection process. The United States Mint's West Point facility produces American Eagle bullion coins in quantity, and the program is one of the most consistent revenue contributors to the Mint's overall seigniorage return. But the program is exposed to metal price volatility in a specific way that a circulating coin program is not. When gold rises sharply, investor demand for Gold Eagle surges, but the Mint's ability to respond is constrained by blank supply. The Mint does not smelt its own gold. It purchases blanks from authorized suppliers. When demand spikes and the blank supply chain cannot keep up, the Mint allocates product to authorized purchasers, premiums in the secondary market inflate, and retail buyers either pay elevated prices or simply cannot get product. The Mint loses no money in that scenario. It sells every coin it can produce, but it also cannot capture the surge in secondary market premiums that dealers and authorized purchasers collect downstream. The three mechanisms, circulating coinage seigniorage, numismatic margin, and bullion premium revenue, reinforce each other in a specific way. The volume of the circulating program justifies the infrastructure. The infrastructure enables the numismatic program at marginal cost. The numismatic and bullion programs subsidize the mandatory losses on pennies and nickels. Remove any one of them and the others become less economically viable. A mint that only produced circulating coins at current small denomination economics would lose money almost every year. A mint that only produced numismatic collector products would have no justification for the scale of production infrastructure it maintains. The structure only works as a portfolio. The case that defines what can go wrong when that portfolio balance fails is not from a rogue operator or a junior company making optimistic assumptions. It is from one of the most well-resourced minting operations in the world. The United States Mint's 50-state quarters program, launched in 1999 and running through 2008, was one of the most commercially successful numismatic programs in American history by volume. At its peak, collectors were pulling billions of coins out of circulation to complete sets, which reduced the Mint's redemption obligations and appeared to show sustained demand. The program generated enormous public enthusiasm and millions of new collectors. Then it ended. The follow-on programs, the Presidential Dollar Series and the America the Beautiful Quarter Series, failed to capture comparable public engagement. The presidential dollars accumulated in Federal Reserve vaults because retail consumers did not want dollar coins regardless of the design on them. By 2011, the Federal Reserve held over $1.2 billion coins in storage at an annual carrying cost of approximately $3 million for the storage facilities alone. The coins had been manufactured. The seigniorage had been collected. But the coins were not circulating, which meant they were not functioning as currency. They were functioning as inventory. Congress eventually directed the Mint to halt production of presidential dollars for circulation in 2011. The coins had cost less to make than their face value. The problem was that their face value was unusable in an economy that had no interest in them. What separates the mints that extract maximum value from their operations from those that merely meet their mandates comes down to four variables that do not appear in a naive assessment of the business. The first is die efficiency. The single most controllable variable in a mint's unit economics is how long each die pair lasts before it must be replaced or reconditioned. An operation running worn dies produces more rejects, more off-center strikes, and more coins that fail automated inspection, all of which either require reprocessing or become scrap metal. A world-class minting operation tracks die life by denomination, alloy, and press type, and schedules replacement before quality degradation shows up in rejection rates. A hardened working die costs between $800 and $2,500 to manufacture. A hubbing die, the master from which working dies are derived, costs considerably more and must be replaced far less frequently, but its failure at the wrong moment can halt an entire production run. The difference between a facility running dies to 95% of rated life versus 75%, across a program producing hundreds of millions of coins annually, can represent millions of dollars in avoided tooling cost per year. The second variable is the numismatic product calendar. Mints that plan their collector releases 18 to 24 months in advance can sequence proof die preparation, packaging design, and retail marketing in a way that eliminates production bottlenecks and maximizes the window for pre-orders. Proof dies require additional polishing steps. The mirrored fields of a proof coin are produced by hand polishing die surfaces to a near optical finish before striking, a process that takes between 4 and 8 hours per die pair depending on the design complexity. Mints that plan reactively end up with proof dies arriving late, packaging delays that push release dates into competing retail windows, and collector programs that underperform not because the product is wrong but because the logistics were. The Perth Mint and the Royal Canadian Mint have both invested heavily in what amounts to a luxury product development pipeline, treating each numismatic release as a product launch rather than a manufacturing run, with dedicated design teams, external licensing agreements for themed releases, and international distribution networks that place product in collector markets across Asia, Europe, and North America simultaneously. The third variable is metal purchasing strategy. A mint buying metal on the spot market for every production run is exposed to daily price movement in a way that a mint with forward purchasing agreements or refinery relationships is not. For silver, where price can move 10 to 20% in a month during volatile commodity markets, the difference between a well-structured forward purchase agreement and reactive spot buying can be worth tens of millions of dollars annually across a large bullion program. This is not a sophisticated financial instrument. It is basic commodity risk management that the least well-run minting operations consistently neglect because the budget cycle was designed around stable metal prices that no longer exist. The fourth variable is rejection rate management, an invisible cost that does not appear in any romantic picture of a coin rolling off a press and into circulation. A commercial mint with a rejection rate of 3% on a production run of 200 million coins is discarding 6 million blanks, reprocessing them as scrap, and paying to resmelt, re-roll, and reblank material it already purchased and processed once. Each rejected coin represents labor, energy, and metal handling cost that generated no revenue. The Royal Mint in the United Kingdom publishes quality standards requiring that circulating coins meet dimensional tolerances within fractions of a millimeter and surface quality standards that automated vision systems enforce at production speed. Meeting those standards consistently is an engineering discipline. Falling below them is a cost that compounds silently across every shift. It works when the numismatic program is treated as the highest margin product in the building. When the die program is managed like a precision engineering operation rather than a consumable cost center. When the metal procurement strategy is designed around forward visibility rather than spot exposure. When the rejection rate is tracked as a key performance indicator at the shift level, not discovered quarterly in the scrap metal reconciliation. When the circulating coin losses are understood in advance and funded through the portfolio structure before production begins, not explained away after the annual report is filed. Consider the scenario that shows what all of this looks like in practice. You are operating a mid-scale mint under contract with a sovereign government. Your facility can produce 400 million coins per year across all denominations. You have a numismatic program releasing 12 collector sets annually, a bullion program producing 1-ounce silver rounds under an authorized license, and a circulating contract covering all denominations from 1 cent to $1. In a good year, stable metal prices, high demand for your silver bullion product, and a numismatic calendar that sells out 3 of your 12 releases at full price, your revenue looks like this. Circulating coin Seigniorage returns approximately $4.2 million after absorbing the small denomination losses. Bullion premiums on 2.4 million silver ounces struck at an average 6% above spot generate $7.8 million in manufacturing revenue. Numismatic margin on 180,000 collector pieces at an average 28% margin above metal and production cost produces $3.9 million. Total operating contribution before overhead, approximately $15.9 million. Against annual facility costs, labor, utilities, maintenance, die replacement, insurance, environmental compliance, of $11 to $13 million, you are generating a genuine operating profit. A small one, but a real one. Now run those same numbers through a different year. Metal prices rise 22% mid-year. Your bullion contracts are at fixed manufacturing fees. Your circulating contract does not reprice until renewal. Your metal purchasing was done on spot. The silver blanks you are buying for your bullion program cost 22% more than they did in January. Your bullion revenue did not increase because you do not own the metal, you manufacture it for a fee. Your small denomination losses in the circulating program widened automatically as metal input costs rose. 2 of your 12 numismatic releases underperform because the themes were planned 2 years ago and did not capture current collector interest. Your total operating contribution falls to $9.1 million. Your fixed costs did not move. You are now generating a margin too thin to fund the next capital cycle, the press rebuilds, the die equipment upgrades, the annealing line that needs replacement. You defer capital. The facility ages. The next contract renewal finds you quoting on equipment that is 5 years older than your competitors. The seigniorage spread that looked healthy in January has quietly eroded, and when it does, every number in the portfolio shifts at once. The largest scenario, a government-owned sovereign mint with a full mandate, removes the contractor's vulnerability to fixed-fee contracts but replaces it with a different kind of pressure. Political mandates to maintain denominations that lose money. Workforce obligations that cannot be adjusted in a down cycle. Capital budgets set by legislative appropriation rather than operational need. The United States Mint spent more than a decade advocating for the elimination of the penny on economic grounds. The penny has cost more to produce than its face value since 2006. Congress has declined to act. The mint produces the penny because it is required to, absorbs the loss because it has no choice, and reports the net figure in its annual submission to the Treasury because the law requires disclosure. At scale, with billions of pennies produced annually, the mandatory loss is simply embedded in the budget and cross-subsidized by everything that works. This is what it means to run a business where the product pricing is set by statute and the customer is the entire population of a country. The building is still there. The presses are running. The sound is the same, rhythmic, hydraulic, continuous. Somewhere in that noise, a coin with a face value of 1 cent is produced at a cost of 3 cents, and a coin with a face value of $1 is produced at a cost of 18 cents. The gap between those two outcomes, -2 cents on one side, 82 cents on the other, is not a problem to be solved. It is the structure of the business, the oldest manufacturing margin in the history of organized civilization, and the reason that a building full of people making money can, with remarkable consistency, lose it.